Welcome to Galaxy Brains.
An infinite amount of cash.
I'm your host, Alex Thorn.
The U.S. banking system is sound and resilient.
Bitcoin made a new all-time high.
If you're not long, you're short.
Satoshi's going to come on there, laugh hysterically, go quiet. All Bitcoin's going to be erased.
Bitcoin's the best crypto out there.
Bitcoin is going to zero.
Welcome back to Galaxy Brains. As always, I'm your host, Alex Thorn, head of firm-wide research at Galaxy. Bitcoin not zero. Got my mini block clock here, and we have a great episode for you today. Zack Pokorny from Galaxy Research is our guest. He's going to talk to us about Galaxy Research's first ever formal governance proposal. We proposed something called MESA, Multiple Election Stake Weight Aggregation, to reduce Solana inflation on the back of the nearly passed but failed SIMD 228 proposal from a few months ago. We'll get into Zach about what that proposal is, what Galaxy Research is proposing, what the motivation is, how that prior vote went, and maybe what the path forward is. Obviously, Bitcoin inflation and emissions don't change, but Solana community very focused on adjusting that rate. And we've got an interesting, I think, take on how to come to an agreement on what the rate should be, even more than us having our own view of what the rate should be. We'll also check in with our good friend Beimnet Abebe from Galaxy Trading, as always, to talk about markets. Quite the little rally here, as you can see on my block clock micro. Bitcoin trading around 94,000. Seems to be charting its own pathway a little bit. Gold even down today as we record on April 23rd, but Bitcoin still holding up after a pretty big rise early this week. We'll get into it with Beimnet and find out his thoughts as to why that's happening. Can it sustain? And what the rest of the market is telling us. Before we get to that, I need to remind you to please refer to the link to the disclaimer in the podcast notes, and note that none of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by Galaxy or any of its affiliates to buy or sell any securities. It's an interesting week. It's an interesting time. Markets are moving, and let's check in with Beimnet Abebe. Let's go now to our friend Beimnet Abebe from Galaxy Trading. As always, Beimnet, welcome back to Galaxy Brains.
Thank you for having me.
I mean, what a difference a week makes, at least in Bitcoin land. But, you know, we've had a rally in equities. The gold rally has faltered. But yet Bitcoin on Monday, so we're recording on Wednesday, April 23rd at around 1 p.m. Eastern. It's important with how fast news is moving that I call out those timestamps for these interviews so that people know when we're talking. On Monday, Bitcoin was up, gold was up. Treasuries, dollars, and equities were all selling. Then Tuesday, gold was down, Bitcoin and equities were up, and dollar was up slightly. And today, equities and dollar and Bitcoin are up again. Bitcoin's almost at 94K. What's your take right now? Where are we?
Yeah, no, I mean, we're just playing headline ping pong right now. And we're nowhere closer to a tariff resolution than we were a handful of days ago. So even with all of the information we've gotten over the past week, we really haven't gotten anywhere, is kind of my assessment. Beimnet came out later after his morning presser and said a deal with China may be 2 to 3 years away. He also said that Trump hasn't approved the cuts to the Chinese tariffs, as was highlighted in the Wall Street Journal article this morning. And, Trump did an impromptu press conference today, kind of walking back a little bit of his positive tone that he had yesterday at the, the 5 o'clock swearing in of Paul Atkins. And so, this seems like an administration that got a little bit worried by what was happening in FX markets, bond markets, and equity markets, and wanted to kind of assuage market participants a little bit. But ultimately, Trump is a protectionist. He wants tariffs, and even the most benign tariff outcomes are still kind of bad. And so, we've had an equity market rally back to kind of the trend highs, 5,500, which is kind of where you were at when you had that big short squeeze day. That was the third highest performing day for the S&P. So we kind of got back to those levels, and we quickly retraced lower once Beimnet was like, hey, Trump hasn't approved the tariff cuts. And, even today, like the someone in the UK came out and said, we're not in a rush to do a trade deal with the US, right? And so, by Trump coming out and sounding a little more soft, like that does kind of give you a little bit less negotiating power. And so, I think if you're sitting as one of the countries trying to strike a trade deal with the US, like, the US is going to be protectionist, and the degree to which doesn't really matter right now. And the other thing I'd like to highlight, though, is all of this uncertainty around tariff policy, right, literally causes businesses to slow down and not do anything, right? If you're telling me that the tariff is somewhere in between 125 and 35% for China, and it's 125 right now, and there's a chance it comes down, like, why am I going to buy anything now when the tariffs are, absurdly high? It's also like I need to plan like years out, and this kind of like volatility from the administration like doesn't make for sound corporate policy. And so I think more and more you're going to continue to see companies not give forward guidance, especially those that are particularly impacted by tariffs, because they just don't know what the next 3, 6, 9 months holds. Yeah, that's kind of where we're at. In terms of Bitcoin in particular, I think the rally in equity markets certainly helps because, Bitcoin has traded predominantly like a risk asset. And as equity markets go up and crypto equities in particular rally, that gives them more ammo in terms of, the at the money stock selling programs that they have. And so the higher these stocks go, the more Bitcoin, some of these players are able to buy. And so, yeah, Bitcoin's well supported right now. And it's one of those assets that, like, once sentiment shifts, like it can become a tsunami pretty quickly. And that's because of things like, short squeezes, right? Like a ton of shorts got squeezed out, yesterday and today. You had multiple standard deviation days in crypto equities. You had like massive, 1,000, like I think there was a 12,000 OI cut that happened yesterday that took Bitcoin up like 2,000 points because somebody had to buy a shit ton because they were getting stopped out. And so like there are things like that that drive price higher. And then when price goes higher, that attracts more people to speculate on it, that drives the stocks higher. And it becomes one of these like reflexive, assets. And it's nice to see. Question is, will that continue? Will stocks go lower and kind of lead to the opposite reflexivity at some point? And so it's nice that Bitcoin's back above 90K and holding there. And it's nice that, some of these crypto equities are bouncing. But in terms of sustainability, that's still a TBD.
Yep. All right. So you're not holding your breath necessarily. We're not headed in your mind imminently back to new all-time highs with Bitcoin after just, it being bearish.
It wouldn't surprise
2
me.
weeks ago, a week ago.
It wouldn't surprise me, and I wouldn't be short the asset right now. I think, what we've always advocated for in Bitcoin for folks is a reasonable allocation in your portfolio, somewhere between 1% and 5%. And I don't think that's ever going to change whether the market's going down or up. This is an asset class that's here to stay. And I'll say, last night, I fell asleep to watching a Ray Dalio podcast, which is what I do in my free time, people. But it was so interesting. It was from a couple months ago. Obviously, Bitcoin hadn't, gone down 30,000 points at that point in time. But it was fascinating how often Ray Dalio mentioned gold in the same breath as Bitcoin, right? One of our greatest macro thinkers, of our generation, consistently thinking about Bitcoin as a store of value in the context of long-term debt cycles, fiscal sustainability, and portfolio allocation, right? Like he is, the king of the all-weather portfolio, etc. And so, it's one of those things that you have to realize that it's still in the macro kind of toolkit. Sometimes it's favored, sometimes it's not. And a lot of times, folks will look at alternative trades. But it is part of the lexicon of a macro investor.
Yeah, it makes sense given its fundamental properties, but then the Veblen good nature of it, right? When it goes up, it becomes more attractive to speculators, sometimes takes over. For a lot of its life, it's taken over. And then people start owning it for risk returns rather than for, hedging purposes. I wanted to shift gears a little bit, still sort of on the Bitcoin topic, though. Cantor Fitzgerald and SoftBank and Tether and Bitfinex have announced a new company, Capital 21 Capital, that will be led by Jack Mallers, and it is described as the consortium is creating a multi-billion-dollar Bitcoin acquisition vehicle that will absorb billions in Bitcoin from the other partners and use the funds it raises in an attempt to replicate the success of MicroStrategy. Masayoshi son and the young Lutnick who runs Cantor, and Paolo and Jack Mallers teaming up to do what, this is from the Financial Times yesterday, says is another attempt at replicating MicroStrategy. What do you think of that? Can the market bear more MicroStrategies? And also, does that change the, SoftBank being involved, one of the largest investors in the world? Does that sort of alter the way that maybe others will think about this strategy?
I think everybody's familiar with the strategy at this point, and investors in MicroStrategy, investors in crypto understand it, and so I think there was a significant first mover advantage to Saylor and MicroStrategy. One, because when he started doing it, interest rates were super low, right? And he could borrow money at very low levels, and given the volatility of his stock, issue converts at very cheap levels. He issued some this year at 0% interest. And so it's going to be very hard for an institution to replicate that, partially because Bitcoin's rallied so much as well, right? Like when Saylor was buying in the 20, 30, 40,000 area and it went up so much, it became a lot easier to justify it. But when you're going to do it at all-time highs, when it's worth this much and it's harder to push higher because law of large numbers, etc., it's a bit more difficult. But I do think there is appetite for this type of paper. Maybe not as much appetite domestically as there once was, but abroad, in markets that don't have a structure like this, where there are tax advantages, where there are potential liquidity advantages, bid offer, things like that. There is a place for those types of vehicles. Like owning Bitcoin in stock form might be better for people than owning it as a commodity or as an asset they have to self custody or trust in a third party, etc. And so I think there is still runway left on that trade, but it's one that I'm very cautious on, because intuitively it doesn't make sense to buy something basically buying something that is worth half as much.
Paying a premium basically for the Bitcoin exposure, right? I think your point is well taken. This is something I've thought about, which is like, maybe in every market, there's a market for one of these to do well, right? Like in Japan or in Brazil or in the US.
Brazil, yeah.
But when you start having a lot in the same market, while the management and such, maybe even the strategies are slightly different, if the strategy involves selling corporate debt to fund purchases, isn't that basically the corporate debt, like the fixed income, the convertible bond buyers? Isn't that the same cohort as people? If 21 Capital does like a convert issuance, isn't going to compete with MicroStrategy's converts, right? Like there's only so much. Maybe there's still more, but it seems like and
the market's gotten smarter in the sense, like, they know that they can be subverted in the cap stack by a new capital structure after they've issued a ton of converts and stuff. So, and a lot of the converts, recently started trading cheap because, credit spreads widened out and the new cap thing. And so there's volatility to this type of stuff. And Saylor, quite honestly, has pumped a lot of paper into the market. And there is kind of like a saturation point. And I would argue you're kind of close to it. But the ATM side of things, the people love stocks, and retail consistently buys stocks, and they like stuff that goes up. And so if something has momentum to the upside, like, people will invest in it. And And so, I think there's a bit of bandwidth, but I would caution that, when you issue debt, you do have to repay that debt, and you can only repay that debt by rolling it or actually paying cash to, exhaust the offering. And so, there will come a moment where, you kind of do have to deal with the debt you've issued. So it might seem like free money right now, but ultimately, like your debt will come due.
All right, last thing before we wrap here, Beimnet. Gold off a little bit, was making new all-time highs almost every day for a couple weeks. As we record again around 1:20 p.m. on April 23rd, it's trading at around 3,300. It got as high as 3,500. This is when equities had been selling off, U.S. fixed income, sovereign debt was selling off, treasuries. When you're in an environment of uncertainty, I think about COVID, right, where people just raced into the treasuries for safety, right? People weren't, or the world, maybe some people were, but on a net basis, people have not been flooding into the long end of U.S. debt, I guess because the stability of the U.S. is in question, and the questions about future inflation rates are in question. But so it looked like maybe they've been piling into gold. Does this the last few days with gold now down, from 3,500 to 3,300, does that tell you anything about, is this sort of still short-term noise, kind of like maybe the Bitcoin is?
It's short-term noise. I mean, the math on the U.S. fiscal stuff has not gotten any better, right? We're running like the most mid-April figures is the deficit is at $1.3 trillion already. Folks are talking about, well, we'll close at a $2 trillion deficit this year, but we're 4 months and change into the year, and you're running 1.3, right? And the fiscal cuts and stuff, haven't really happened in a meaningful way, and so the fiscal situation isn't getting any better, and the tariff resolution is still very, very long away. Besant's saying 2 to 3 years for a trade deal with China, right? And so, and you just have to think about why gold is going up. It is a flight to quality, but it's also a flight away from dollars. And if you just think about investing over the past 2 decades, right? The whole world is overweight US equities and US assets still, and US dollars, right? You can't go from overweight to market weight in the span of 3 weeks if you're, a real money, huge institution, sovereign wealth fund, reserve manager, large bank, whatever it may be. And so that shift just takes time. And what you have to also keep in mind is that, gold not only has, a bunch of central banks buying it, real money buying it, but there's a ton of speculators in that market, retail players in that market. And so it's going to exhibit noise along the way, but fundamentally, nobody's fiscal situation is really getting that much better. The fundamentals of gold get better every day as the US and other parts of the world continue to have to pay tons of money to service debt. And that ultimately eats into, productive capacity for those dollars. And, if you really think about where we are in kind of long-term debt cycles, it's not looking good. And the math catches up to you, quicker. And so every day, the debt goes higher, and and with long-term yields rising, it gets more expensive to finance that debt. And it comes at the cost of huge productivity gains that you would have had otherwise. And so it's not, it's not something you should think about in day-to-day movements. It's something that you should think about in monthly, quarterly, yearly movements.
All right, my friend Beimnet Abebe from Galaxy Trading. Thank you so much.
Thank you for having me.
Let's go now to our guest, Zack Pokorny from Galaxy Research. Zack, welcome to Galaxy Brains.
Yeah, it's been a while. Thanks for having me.
Yeah, it has been. And it's a super interesting time. Galaxy Research has proposed I guess it's not a Solana improvement document quite yet. It is a proposal for one called Multiple Election Stake Weight Aggregation, MESA, for reducing SOL inflation. This comes on the back of a big debate from February and March around SIMD 228, a proposal to reduce Solana inflation, which narrowly failed. Zach, why don't you just give us the quick introduction here as to what we're proposing, and then we'll get into the background, the motivation, all of that.
From a super high level, the idea is to just present validators with a richer set of options in voting on the outcome of a proposal. So it's more of a focus on the process of how we can reach an outcome with less friction than perhaps a typical yes, no, abstain style vote would allow for.
So instead of yes, no, abstain, hey, do you want to do X, Y, X? You either do, you don't, or you vote abstain. This idea is that there's multiple yes options, right? And it only really works if the question is quantitative, right? Because you got to combine that math at some point.
Yeah, exactly. So it has to be quantitative, and also each validator has to have like a separate opinion on it. Like, it doesn't really matter if everybody's kind of directionally thinking the same way. It kind of only works when there's a difference in opinion on what the ultimate outcome should be, but we all kind of cumulatively agree on the end goal that X should happen. We're just going to take a different path.
Yeah, like to what degree should X happen? So as a simple example, and then we'll get into the specifics of this and SIMD 228. But like, let's say you wanted to know what the Fed funds rate should be, or the Fed was trying to decide, and they would say, one Fed governor says it should be 2%, another says it should be 5%, several others are in the 2 to 5% range. They could all vote, and then some math would be done, either average or median, among those who said they wanted it changed to one of those. Which change should we arrive on? And it's more democratic. It takes the input from all the voters, in some way, either the average or the median or some other math.
Yeah, and I think the key here too is it lets people act selfishly. Like, we don't all just need to cumulatively agree on some like fixed predetermined number. It's everybody does their own research, they live in their own circumstances, and they can openly express that in the vote, which I think is also a big key here.
So before we get into 228 and the motivation for this proposal specifically, what are those choices in this example? The idea is to reduce Solana inflation. Is that right? Or should I say pull forward the reaching of the eventual terminal inflation rate? Like, what is Solana eventually going to terminate its inflation rate at, first of all?
Yeah, so the way Solana works right now is it decreases by 15% each year until it hits the terminal rate of 1.5%. Essentially, what our proposal does is give people a set of options to vote on what that 15% should be changed to. So we're not necessarily
the decrease amount, the annual decrease or decay of the inflation rate.
Exactly. So like, you're kind of just steepening the emissions curve and not necessarily like fully altering it per se.
So you would say, like, currently it decays 15% a year, and so after some amount of time it reaches that terminal 1.5% annualized inflation rate. And this proposal offers 15%, as in no change at all, and then greater decays per year, right? So up to some amount. We don't specify how high, but theoretically as high as 30 or 50%, right? The idea is that if you agree that the inflation rate should decay more quickly, well, how quickly should it decay? You can pick. And then is the idea that, like, so you got validators on this proof of stake network, and the stake with which they validate is either theirs or from delegators that delegate to their validating node, or a combination. And is there precedent for validators splitting their votes across multiple options?
Yeah, and I think that's what makes this proposal especially interesting is in the last 228 vote, Anatoly himself kind of advocated for the fact that validators can split votes. You don't just have to be all in on yes and all in on no. You could do some ratio of the two, and you can even pull the people who are delegated to your validator for an answer. So in some cases, validators were going to individuals and saying, hey, do you want this to pass? Do you not want this to pass? And then they kind of reflected that in their yes, no, abstain vote. What's especially interesting about that component of this whole thing in the context of MESA is you can actually have individual stakers voting on what they think the inflation rate should be. So like in a hypothetical example where you have 3 people staked to one validator, they could be an institution, an individual, or maybe like some kind of fund. they all have different opinions on what it should be, and they could actually directly vote on what they think the inflation rate should be, which that's never been done before, at least to my knowledge.
I think that's the coolest thing here. And obviously this vote is about the inflation decay. But the idea of what we called multiple election stake weight aggregation, MESA, is that in situations where there is, let's say some agreement that something should change, a parameter, but that the possible parameter changes exist on a range, that validators could vote across that range. And then after the vote, if the total yes change vote is a supermajority to pass in general, then the change that is implemented would be the result of aggregating those votes across the range. So for example, the average or the median, right? If 10% vote, keep it at 15, if 10% voted at 17.5, if 50% voted at 20, if the remaining 20% voted at 30, then yes has won, but it would then take some kind of average between the 15 and 30 that was voted as the actual new.
Yeah, it essentially just bakes together the opinion of everybody to find.
Yeah, it's a very democratic approach.
Yeah, and it's interesting because it's at the protocol level. Like maybe there's been precedence for something like this at like the DAO application level, but if you look at how other networks go about governance, at least at like the level of making a major change to the underlying protocol, it's not typically done this way. So I think it could also just be an interesting first for the Solana community.
Yeah, it does seem new, and it's definitely not. It's not really. Well, I mean, it depends. There are certain types of ways of signaling support for a fork in Bitcoin that are sort of by hash rate and by blocks produced, but it's different. This is a little bit like futarchy, right? It's a little bit like a market-based approach. How do those relate? I know you're a big futarchy guy.
Yeah, I mean, that's kind of where the inspiration from this drew from. We were just kind of like messing around on the desk, like, oh, why don't we just make the entire curve itself be a futarchy market where everybody like puts up some kind of stake to say like, oh, at 40% stake rate, we want it to be like 5% and so on. But that model doesn't really fit into how Solana has done governance, at least historically. So like doing it that way would require a major overhaul.
Right. The validator architecture and governance architecture can't actually support an actual futarchic market. Futarchy, for those listening that don't know, is a form of government proposed by an economist, Robin Hanson, that suggests that elected officials will produce possible outcomes and then prediction markets will determine what the best outcome is. And then that would be the policy that is enacted. So it's not a prediction market here, but it is voting. It's really, honestly, it's like a democracy, but it's just really making validator votes more democratic than actually futarchic. But it does raise the idea of a curve emerging, a voting curve of preferences like a futarchy would. So, Zach, let's talk about 228 and some of the motivation that led to this. What was the 228 proposal that was a big deal in the Solana community a couple months ago?
Yeah, so the proposal itself was an effort to reduce Solana inflation. There's a number of reasons why. I mean, one, to just decrease dilution and not let people who are staking grow to a size that is like too disproportionate to the people who are choosing not to stake. But the approach by which they kind of went about it was setting a dynamic curve where, depending on what share of circulating SOL was staked, it would set some rate of inflation. So, I mean, this is just a hypothetical example, but at like 25%, it would be 1% inflation. At 50, it would be 2, and so on. And then as the stake rate kind of fluctuated, or the amount of SOL being staked fluctuated, the interest rate would, or the staking APY would just dynamically adjust.
Is it similar to EIP 1559 on Ethereum?
In some senses, yes. I don't believe ETH like explicitly says like at this stake rate we have this amount of inflation, but it's like if we have this number of validators, then this amount of ETH is issued annually, and so on. So it is dynamic in that sense, but it's not like a one-to-one.
So they call it a market-based emission mechanism. Is it market-based, or is it network activity based? Like, how should we? Are those the same thing? Like, how should we think about that?
I mean, I think it's market driven in the sense that stakers have a choice of staking or not. And if they don't perceive the staking APY to be sufficient enough, they will go elsewhere to chase yield. And then once it becomes appealing again, like they can come back, and the staking APY will just kind of adjust on that basis. And like today, like if people don't think it's high enough, they would just leave, and then there would be a decrease in the inflation rate, and then maybe it would go back up if people chose to stake again, for example.
So this was originally sort of proposed as a reason, as a mechanism to reduce inflation. So similar to the goal that your proposal makes, although this is a dynamic emissions model, whereas in the MESA proposal, we're proposing simply a range of fixed decay amounts that the community would decide on. Is that right?
Yeah, that's correct. So we're just kind of keeping the exact model that Solana already has in place, and we're just kind of tweaking one of the parameters of it. So it's not like a major protocol change like a dynamic curve might be, but it does achieve the goal of at least reducing inflation, at least more quickly than is currently implemented.
Yeah, and is that, what's your sense from following the debate on 228? Like, did the community think of that as more of an effort to reduce emissions, or more as the introduction of the dynamic emissions mechanism in your mind?
I mean, I think the ultimate goal was to reduce inflation, and the dynamic curve was just a way of expressing that. Because like the dynamic curve, you just present parameters that are lower than the inflation rate today, and you achieve the same goal of, say, just accelerating.
It will be lower.
Yes, exactly. Like you are lowering it because you're lowering the parameters, and then you're just kind of expressing that through the dynamic curve, which may present additional benefits somewhere down the line.
So you wrote in the proposal that it was our view that the community, while it didn't pass 228, appeared to mostly agree inflation should be lower.
Yeah, I think when you were watching like the vote unfold and debate going back and forth, there seemed to be this like split where it was the fixed curve group versus the dynamic, and there was huge debate along that line. But when the vote was over and the dust settled, everybody was kind of like, that was crazy, but we do, for the most part, appear to agree that the inflation rate does need to be addressed at some point, whether it's immediately or some other time down the line. But
yeah, one of the interesting things that you were telling me about, and I'm looking at the 228 and 221 discussions here on GitHub. This is widely discussed, it looks like, was that, and I would love your take on this, like, why reduce inflation? Why does the community want emissions lower overall? I mean, I could give plenty of answers to that, but I think the obvious one is that it reduces supply growth, and in a very supply demand, based economy, like that could be supportive of the price of SOL, but there's more to it than that, right?
yeah, I mean, I think you have the component of users choosing to stake growing to a size that's disproportionate to the people who aren't, which is just kind of like downstream of dilution. But yeah, I also think the other major thing is like these are assets that trade and are, for the most part, supply demand based. So like if you're thinking about it from the asset perspective, it's obviously beneficial to not be diluting and growing the supply at an outsized.
So what is the emissions rate today that everybody thinks should be lower, Zach?
It stands at about 4.5, 4.6%, somewhere in that range.
So that's too high, we think. The community thinks, or we think that the community thinks that that's too high. And so one reason why 228 almost passed, and also why our proposal also is about reducing emissions, other than just the supply demand dynamics for the, its impact on token price, like what are other major reasons why a lower inflation rate would be good for the Solana ecosystem?
Yeah, I mean, I also think it's important to consider the context of these assets in markets, like specifically DeFi, where Solana DeFi is based around SOL, the asset, like its native asset. So in the inflation rate for that, whether it's like whatever the number might be, it kind of sets like this risk-free floor that all other interest rates kind of coalesce around. And you see that with unstaked SOL and lending markets. The supply APY and the borrow APR are about equal to the staking APY. And then if that were to like lower overnight or go up overnight, you would watch it follow. But it kind of sets like this baseline rate around which interest rates broadly might be set in markets. And I mean, when you think about like the context of things like stable coins, which there's obviously like other factors that go into this, like general liquidity and whatnot, but you're kind of comparing all of these things on like a market basis. So like if you look at Ethereum, for example, interest rates are significantly lower than they are in Solana, specifically around stable coins, than obviously SOL, the asset itself, just because of the difference in the two inflation rates. So yeah, you can kind of view it as the risk-free rate, and an economy that's operating with a higher interest rate is obviously at some disadvantage to ones that are much lower.
Yeah, so a couple points that it sounds like you're making. One, if you can just stake your SOL and earn more than you can lending it in DeFi, you might, right? I mean, and so does it inhibit the growth of Solana lending markets because there is this highly competitive, quote unquote, risk-free rate of simply staking it?
Yeah. And I mean, again, I think it's also like comparative. Like, why would I necessarily go to a market that has higher interest rates versus one that's lower? So like the outright number isn't necessarily bad. It's just when you compare it on a relative basis, that like all of these ecosystems and applications are kind of competing on, it just becomes more uncompetitive.
Then you compare it to the native rates in the Ethereum ecosystem, which you made a chart yesterday showing me how the Lido APY, which is staked ETH, which is derivative of the ETH staking APY, has been converging with the DeFi, lend rate on Ethereum for ETH, right? Like that they come together, but they're also together lower than SOLs. It's more attractive to borrow ETH and lend SOL, right?
Yeah, I mean, it depends on what the use case is. A lot of the convergence comes from people looping and kind of taking advantage of the difference in the borrow APR and the stake rate. But where I think it becomes like a little bit more interesting is like I want to use ETH as collateral to borrow, say like USDC. Like if the collateral only yields 8%, or only 3% in the case of ETH, I may have less tolerance to pay 15% on a USDC loan, whereas it's the opposite in Solana. And you kind of see that being reflected in the stablecoin interest rates. Like if you laid the borrow curve of USDC on SOL over the same curve on ETH, it's significantly higher, specifically towards the top end of the utilization curve.
So, all right, let's talk about dynamic versus fixed, because that's the other change here. We both of them, as 228 was proposed and as we're proposing, lower inflation. That we know, lower emissions, or accelerate the time to decay towards terminal emissions rate. What are the benefits of a dynamic and cons of a dynamic? Let's start there.
Yeah, I mean, starting with the pros, and the dynamic curve really takes like the network component of the equation into better consideration. Because like the way I think about these things is SOL, the asset, lives between Solana, the network, and then the rest of the market, which includes DeFi. And you're kind of competing on yield opportunities. So the dynamic curve kind of caters more to the network side of things, where it's like we want to incentivize people to stake and unstake as they kind of see fit. And that may be a function of like maybe market conditions or just general security levels, like broadly. Like if there's not enough security, or which would be manifested as like a low stake rate, the inflation would be higher to incentivize people to come back, which obviously the fixed curve does not do. It doesn't take any of that into consideration. I guess the downsides of the dynamic curve, it really just kind of feeds back into the idea that Solana, the asset, lives between the network and then financial markets, and there's a million ways you can earn yield. Staking is just one of them. So people will either completely ignore it if the parameters of the curve aren't adequately benchmarked against what you can get in the market. Like if I could get 7% in the market and the max inflation or max stake APY I could get is 5%, you're never even going to consider staking. So like that's kind of like the one big component. Then two, it's like, is stake really that fluid? Like you have so many different parties kind of jumping in on this, and the ETFs will make this especially interesting because they are big blocks that are presumably going to be relatively sticky. And if they get the staking component of the whole thing, they may just be like staked for an extended period of time, regardless of network conditions. And then you also have things like LSTs, which allow people to capitulate and never actually unstake. So it's also like a question of, is stake fluid enough to even allow the curve to work in the first place? But obviously it does have the pro of kind of taking network security into consideration that the fixed curve does not have.
And what about like design implementation? It's a lot more complicated than just like changing a couple lines of code to, adjust the decay rate.
Yeah, I mean, on a relative basis, it would definitely require more effort.
Okay, now and then fixed. I mean, again, this is all assuming that you want it lower in general. Like, it's currently fixed, right? Why is that good, or what are the limitations there in your mind?
Yeah, I mean, I think it's the predictability component, the idea that it's very hard to engineer the perfect curve such that you get like everything you want out of it. And the fixed curve just kind of says like, you know what, like we understand this is difficult, but we do know that we want inflation lower, and we will get there in time, kind of wean people off of the high rewards that they're used to. So it's not like an immediate switch, even though in 228 they proposed like a 50 epoch grace period, which is about 100 days. But this would just kind of allow the vote to either, I mean, if it does pass, it would allow it to go into effect immediately and then kind of wean everybody off of it gradually versus just kind of like this overnight shock.
In your mind, having written this, like, I mean, are you dogmatic about the actual inflation rate, or is it more about the interesting, like, what is it in the Solana community that makes you want to help get to an answer here? Like, is it the mechanism or the outcome that is the core of this proposal?
Yeah, I mean, just kind of observing 228, it's just let's get an answer to this question with as little friction as possible. Like, I think it was like very distracting, and people were like obviously very like animated over the whole thing, which like historically the Solana community hasn't like been so much of that. So I think that this is like a good way to reach consensus with as little friction and as little division as possible, so that like more important things can kind of be focused on.
Well, it's super interesting. It's our first ever governance proposal for an L1 or any other type of DAO structure. I encourage people to check it out. I'll put the link in the show notes. And, Zach, keep covering it for us. We'll bring you back if we make progress or if the community has a deep reaction to it that is worth covering for this audience. Appreciate it, Zack Pokorny from Galaxy Research.
Thanks, Alex.
That's it for this week's episode of Galaxy Brains. Thank you to our guest, Zack Pokorny from Galaxy Research, and our friend Beimnet Abebe from Galaxy Trading. Everyone have a safe and happy weekend, and we will see you next week. Thanks for listening to Galaxy Brains, the weekly podcast from Galaxy Research. If you enjoy the show, please like, rate, review, and subscribe wherever you get your podcasts. To follow Galaxy Research, sign up for our weekly newsletter at gdr.email, read our content at galaxy.com/research, and follow us on Twitter at GLXY Research. See you next week.